the geopolitical tax on monetary policy. The Federal Reserve's pause reflects a strategic pivot from domestic data to global instability as the primary driver of its calculus. The Federal Reserve's decision to maintain its benchmark rate underscores a fundamental shift in the operating environment for central banks.
While domestic economic indicators such as employment and core services inflation remain relevant, the Federal Open Market Committee (FOCM) is now explicitly hostage to exogenous shocks emanating from global conflict zones. This creates a policy dilemma, where traditional tools are ill-suited to address supply-side inflation fueled by energy price volatility, effectively imposing a de facto tax on growth.
The current stance is not one of strength but of strategic paralysis, awaiting clarity on whether geopolitical friction will metastasize into a sustained inflationary impulse or gradually subside.
From demand bull to supply shock inflation, the underlying inflation driver has shifted, rendering conventional monetary policy responses both blunter and more economically dangerous. Historically, the Fed's mandate has focused on managing demand bull inflation through interest rate adjustments that influence borrowing costs and consumer spending.
The current paradigm, however, is defined by cost-push inflation originating from disrupted commodity flows and heightened security premiums in global trade. This matters profoundly in the current climate because tightening monetary policy to combat such inflation does little to address the root cause geopolitical strife while aggressively suppressing domestic demand.
Consequently, the higher for longer interest rate narrative is less a confident forecast and more a risk mitigation strategy against unquantifiable external variables, placing the Fed in a reactive rather than directive posture.
The mechanics of a policy trap: elevated energy prices function as a simultaneous growth suppressant and inflation accelerator, creating a no-win scenario for rate setters. The intricate mechanics of this bind reveal a dangerous feedback loop.
Rising oil prices directly increase headline inflation figures, while also acting as a drag on consumer disposable income and corporate profit margins, thereby slowing economic activity. For the Fed, this creates a policy trap, hiking rates to tame inflation risks, exacerbating the downturn, while cutting rates to stimulate growth could further de-anchor inflation expectations if supply shocks persist.
Market pricing now reflects this ambiguity, with forward curves pricing in fewer cuts and prolonged volatility across bond yields and equity valuations. The Fed's communication has thus pivoted to managing expectations around patience, explicitly linking its future actions to the evolution of geopolitical risks and their translation into persistent price pressures.
A protracted era of financial repression. Investors must navigate a landscape where capital allocation is dictated by political risk premiums, not just economic fundamentals. The strategic verdict is that the era of predictable monetary policy cycles is over, replaced by a protracted period of financial repression where real returns are compressed by geopolitical uncertainty.
The predicted consequence is a continued repricing of risk assets, with sectors sensitive to interest rates and input costs facing sustained pressure. Strategic next steps for institutional portfolios involve hedging against stagflationary scenarios through real assets, diversifying away from pure rate sensitivity, and adopting a tactical, rather than strategic, duration stance.
The ultimate risk is a central bank forced into policy error by a world it cannot control, making vigilance toward geopolitical developments as critical as analyzing economic data.